Ladies and gentlemen, what you are about to hear could be one of the most important financial alerts of your lifetime. I'm not here to hype you up, I'm here to wake you up. Because if you own gold or silver, especially silver, what's happening right now isn't just another uptick in price. It's a structural shift in how the world thinks about money, and those who recognize it earlier are the ones who will benefit the most. What most people still don't understand is that we are not living through a normal economic cycle. This isn't a routine slowdown. It's not a temporary inflation spike, and it's certainly not something that can be fixed with another quarter-point rate adjustment. What we are witnessing is the slow-motion breakdown of the modern monetary system, a system built entirely on confidence, debt, and the illusion that money can be created without consequence. For decades, central banks have conditioned investors to believe that every problem can be solved with more liquidity. Markets fall, print money, banks fail, print money, government deficits explode, print even more. The result is a financial structure propped up not by productivity or savings, but by artificially suppressed interest rates and an endless expansion of currency units. And while this may create the appearance of prosperity in asset markets, it quietly destroys purchasing power in the real world. Inflation is not an accident. It is not caused by greedy corporations or temporary supply chain disruptions. It is the direct result of expanding the money supply faster than the production of goods and services. When governments spend money they don't have, and so central banks monetize that debt, the currency inevitably loses value. You may not notice it immediately in headline statistics, but you feel it every time you go to the grocery store, pay rent, or fill up your tank. And here's the critical point. When confidence in fiat currency begins to erode, capital doesn't disappear. It migrates, it flows out of paper promises and into tangible assets. That's where precious metals come in. Gold and silver are not speculative trades. They are monetary metals with a track record measured not in decades, but in millennia long before modern central banks existed. Gold and silver function as money because they possess qualities that fiat currency simply does not. Scarcity, durability, divisibility, and intrinsic value. They cannot be printed at will. They cannot be digitally manufactured with a keystroke. When the monetary system begins to crack, precious metals grow because of hype. They reprice to reflect the declining value of the currency in which they are measured. That's an important distinction. Gold rises from 12,000 into 3 zone. It doesn't mean gold suddenly became more valuable. It means the dollar became less valuable. We are now seeing the early stages of that repricing process. Governments around the world are drowning in debt. The interest expense alone is becoming unsustainable. The only politically acceptable solution is further monetary accommodation, which means more currency creation. But every new round of liquidity makes the underlying problem worse. It accelerates the loss of purchasing power and increases the eventual adjustment. At the same time, real interest rates, when adjusted honestly for inflation, remain deeply negative in many parts of the world. Negative real rates are rocket fuel for precious metals. When savers realize they are guaranteed to lose purchasing power by holding cash or bonds, they begin searching for alternatives. Gold and silver become logical destinations. Silver in particular often outperforms during these phases. It is both a monetary metal and an industrial metal. That dual role creates a powerful dynamic. As monetary demand increases due to currency debasement, industrial demand continues to absorb supply. The market for physical silver is relatively small compared to global financial assets. It doesn't take a massive shift in capital to create significant price movement. Meanwhile, the mainstream financial media continues to focus on stock indexes and short-term economic data, missing the larger structural shift underway. Investors are conditioned to think in quarterly earnings reports, not in monetary cycles, but monetary cycles ultimately dominate everything else. When the foundation, the currency itself, weakens, asset prices must adjust. Precious metal outperformance during a monetary breakout is not a theory, it is a historical pattern. Every time governments overextend fiscally and central banks monetize that excess tangible stores of value eventually surge. It doesn't happen in a straight line. There are pullbacks, corrections, moments designed to shake out weak hands, but the long-term trend reflects the underlying debasement of currency. The biggest mistake investors can make right now is assuming that what worked in the era of easy money and stable confidence will continue indefinitely. The conditions that supported inflated bond prices and overvalued equities are changing. Debt levels are too high, political incentives favor inflation over austerity, and central banks have demonstrated repeatedly that they will prioritize short-term stability over long-term currency integrity. As this realization spreads, precious metals don't just participate, they lead. They become a barometer of trust in the system, and when trust declines, their performance accelerates. This isn't about chasing a headline or speculating on a short-term spike. It's about understanding that the monetary system itself is under strain. When that strain becomes visible to the broader public, the repricing of gold and silver can happen faster than most people expect. Those who recognize the structural breakdown early position themselves accordingly. Those who wait for universal confirmation usually arrive after the most significant gains have already occurred. In the end, the outperformance of precious metals is not a mystery. It is the market's verdict on fiat excess, and that verdict is becoming clearer by the day. There's a fundamental reality in the silver market that most investors completely ignore. And that's because they're too busy watching short-term price charts instead of studying the underlying structure. Silver is not just another commodity that happens to fluctuate with economic cycles. It is a monetary metal with industrial utility layered on top. And right now, the structural dynamics of supply and demand are setting the stage for something far bigger than rally. Let's start with supply. Unlike fiat currency, silver cannot be created out of thin air. It has to be mined, refined, transported, and fabricated. And here's what most people don't realize. The majority of silver production is not even primary. It's a byproduct of mining other metals like copper, lead, and zinc. That means silver supply is not simply ramped up because the price rises. It's dependent on the economics of entirely different markets. Copper miners, slow production due to weak industrial demand, silver supply contracts regardless of how strong silver demand might be. So even if silver prices start moving higher, miners can't just flip a switch and flood the market. The pipeline is rigid, it's slow, capital intensive, and it's constrained. At the same time, years of underinvestment in mining exploration are now catching up with the industry. Low prices in prior years discourage new projects, environmental regulations have tightened globally, permitting has become more difficult, labor and energy costs have risen. All of this means that bringing new silver supply online is far more complicated and expensive than most people assume. Now let's look at demand, and this is where the story becomes explosive. Silver is essential in a wide range of industry applications. It's used in electronics, medical equipment, solar panels, electric vehicles, and advanced technologies. Unlike gold, largely held for monetary and jewelry purposes, much of the silver used in industry is consumed. It's embedded into products in small quantities that are often uneconomical to recycle. That means once it's used, effectively removed from the above-ground supply. As the global push toward electrification and renewable energy accelerates, silver demand from the solar sector alone has surged. Every solar panel requires silver for its conductive properties. The more government subsidizes green energy initiatives, the more silver is absorbed into industrial production. That demand doesn't disappear just because the price ticks up a few dollars. On top of that, you have monetary demand re-emerging. When inflation rises and confidence in fiat currencies weakens, investors look for tangible stores of value. Silver, being more affordable per ounce than gold, often attracts retail investors in large waves. It becomes the everyman's money. And because the silver market is significantly smaller than gold in terms of total dollar value, even modest inflows of capital can create outsized price moves. This is where the structural deficit comes into focus. For several consecutive years, global silver demand has outpaced new mine supply. That gap has been filled by drawing down inventory stockpiles that are not infinite. You can only pull from reserves for so long before the market tightens dramatically. And here's the key point. Markets don't adjust gradually when physical shortages become evident. They adjust violently when industrial users begin competing with investors for available supply. Price becomes the rationing mechanism. Higher prices are not a bug in the system, they are the system's way of balancing scarcity. Most analysts focus on paper silver markets, futures contracts, ETFs, derivatives, but those instruments ultimately depend on the availability of physical metal. If physical demand overwhelms available supply, paper claims become less relevant. Confidence in synthetic exposure weakens. Investors start demanding delivery instead of settle. That's when price discovery changes. The complacency that we see today reminds me of previous periods when markets ignored structural imbalances until they could no longer be ignored. Silver market is relatively small compared to global equity or bond markets. It doesn't require trillions of dollars to create a squeeze. It requires a shift in perception, a realization that the metal is both strategically necessary for industry and monetarily valuable in times of currency debasement. And consider the macro backdrop. Governments are running persistent deficits. Central banks are trapped between fighting inflation and preventing financial instability. Real interest rates remain historically low relative to inflation risks. All of this increases the attractiveness of hard assets. If monetary demand accelerates at the same time industrial demand remains strong, the supply deficit widens. And because supply cannot quickly respond, price must adjust upward to restore equilibrium. Investors who view silver purely as a speculative trade miss the bigger picture. This is not about chasing a short-term spike. It's about recognizing that structural deficits create asymmetric opportunities. When a market has been underpriced for years due to paper leverage and complacency, the eventual repricing can be dramatic. The silver market today reflects years of suppressed signals, but fundamentals have a way of asserting themselves. When structural shortages meet rising demand, prices don't inch higher politely. They surge until demand destruction or new supply finally stabilizes the imbalance. We are approaching a period where that imbalance may become impossible to ignore. And when that recognition spreads beyond a small circle of informed investors, the adjustment in price could be swift, decisive, and far larger than most models currently project. One of the most overlooked indicators in the precious metals market, and one that quietly signals opportunity long before the mainstream catches on, is the gold to silver ratio. Most investors don't pay attention to it because they're too busy chasing headlines or reacting to daily price swings. But if you step back and look at the relationship between these two monetary metals over time, start to see something far more important than short-term volatility. You see relative value, and right now the relative value is flashing a very clear signal. The gold to silver ratio simply measures how many ounces of silver it takes to buy 1 oz of gold. Historically, that ratio has fluctuated, but over long stretches of monetary history, when both metals actually functioned as money, the ratio was far lower than what we've seen in modern paper markets. There were periods when the ratio hovered around 51 or 11, reflecting the relative abundance of each metal in the Earth's crust and their long-standing monetary roles. Today, the ratio has often been dramatically higher. That doesn't necessarily mean gold is overvalued. In fact, gold itself remains undervalued relative to the expansion of global money supply. What it suggests instead is that silver has been disproportionately discounted, and when you see extreme readings in the ratio, history shows that they don't persist indefinitely. They revert, and that reversion tends to be swift and powerful. Silver is a smaller market, has higher volatility, and tends to lag gold in the early stages of a precious metals bull market. But once momentum builds, silver doesn't just catch up, it frequently outperforms. That's because it behaves like leveraged gold. When investors begin reallocating capital into hard assets as protection against currency debasement, gold often moves first as the primary monetary anchor. Then as confidence builds and the move broadens, silver accelerates. Dynamic is not accidental. Gold is primarily a store of value. Central banks hold it. Large institutional investors hold it. It is the foundation of monetary insurance. Silver, on the other hand, is both monetary and industrial. That dual demand base creates additional pressure when investment flows increase. If monetary demand rises at the same time, industrial consumption remains firm. The available supply tightens quickly. When the gold to silver ratio stretches to historically high levels, it often reflects excessive pessimism towards silver or excessive complacency in paper markets. It can signal that investors are estimating silver's monetary role, but markets correct imbalances. They always do. And the correction in this ratio historically comes not because gold collapses, but because silver surges. Think about what happens in an environment where inflation proves persistent, sovereign debt continues to expand, and real interest rates remain suppressed. Gold benefits as investors seek safety, but once gold establishes an upward trend, attention turns to relative value. Investors begin asking a simple question. If gold is rising due to currency debasement and silver is historically cheap relative to gold, why not